So we're going to move on to SEIS and EIS, which is otherwise known as Seed Enterprise Investment Scheme and Enterprise Investment Scheme. We're going to look at it from both aspects. We're going to look at it from the company's point of view, who want to be able to say that their shares qualify for SEIS and EIS, so that they can attract investors to come and buy, invest share capital in them, equity. And we're going to look at it from the investor's perspective to see what tax reliefs they get, and they get income tax relief and capital gains tax relief if they invest in qualifying shares that qualify under SEIS and EIS. So let's start with SEIS to begin with, because that was actually a very recent development that was brought about, and it mirrors the rules of EIS. So we'll start with that, and I'll just tell you the subtle differences at the end between the two. So SEIS is aimed at really small start-up companies that are risky but need to go out and raise finance under equity. And it's meant to help them encourage investors who have got a bit of spare cash to invest in them. And there is huge tax relief for those individuals in doing so. It was introduced in April 2012. It was supposed to expire in 2017, but they've removed that expiry date because it has actually been quite popular in the current market. And the idea is that a company that issues shares that qualify under SEIS will then go on to issue further shares under EIS, but you can't go the other way. So if you've already issued shares under EIS, you can't then go and issue shares under SEIS. And the subtle difference between SEIS and EIS is that EIS is aimed at, again, start-up companies, but high-risk start-up companies. So, there's what I've put it in your notes, and I'm going to really whiz through it really quickly because we'll be here forever if I don't, but there's lots of conditions for you to be able to qualify for this, and I just want to literally run through it, but I wanted you to have it in your notes so that if you think this is something that might be of interest to you, you can at least refer back to the notes and then ask us later to make sure you do qualify. So basically, the individual will subscribe for shares in a qualifying company, and I'll tell you in a minute what a qualifying company is, but the maximum amount they can invest in any 1 year is £100,000 under SEIS, and they must pay for them shares. There cannot be no creditor. They have to pay that 100k or less in full. And once they have invested that 100,000 or whatever the number is, they cannot own more than 30% of that company. And that 30% includes associates, so that will be things like their wife, their children, their parents, not their brothers and sisters, but it will be any business partners. If they've got a trust that they're the settlor of, you need to consider those to make sure they're not within this 30% test. And they must own them shares for 3 years to get the capital gains tax and income tax relief, and I'll tell you what those are in a moment. Bizarrely, you cannot be an employee of that company, but you can be a director. And it sounds a bit bizarre, but you need to have a UK tax liability, because how the relief works is you actually get a deduction from the amount of income tax you have to pay. So if you haven't got an income tax liability, this relief is useless to you. You don't have to be UK resident, because you can be non-UK resident and still have a UK tax liability. And as I said, you must own those shares for 3 years. So when the company issues those shares to the investor, it must be an unquoted trading company, so it can't be listed on the stock exchange, basically. It must have less than 25 employees, and that includes its group if it's got subsidiaries. It can have greater than 51% subsidiaries. It can be the parent. Its gross assets, including the group if it is a group, cannot be more than 200,000. So these are small companies that literally just have started up. So its gross assets, i.e. its stock, its debtors, its cash, its plant, if it's got any, its fixtures and fittings, cannot exceed 200k when it issues the shares. And you can't have any investment from venture capital trust for some reason. I don't quite know the reasoning for that. And when you do issue those shares, as I said, you cannot have done EIS. You've got to do SEIS first. And the total amount of equity they can raise under SEIS is only £150,000, so it's not a lot. It can almost be done by 2 individuals as long as they don't end up owning more than 30%. And when they issue those shares, they must have traded. Their first trade has to be less than 2 years older, but they don't actually have to have started trading at the point they get the equity. As I said, it can have greater than 50% subsidiaries, but in an ideal world, it wouldn't be the subsidiary that is trying to claim SEIS. You can put a parent company on top if it is the subsidiary that's claiming SEIS relief, but you've got to have genuine commercial reasons, and it's really hard actually to get through that loophole. So I wouldn't advise it really. It's got to be a UK resident company. So what is a qualifying company? Well, it's got to be, as I said, an unquoted company, and it's got to have a qualifying trade. So it's got to be trading on a commercial basis with a view to making a profit. And there are trades that are considered bad. So if you trade in land and if you trade in insurance and financial services, that sort of thing, you're not allowed to do this. But if you're just a normal trading company, you're absolutely fine. And they have to spend that 150,000 within the first 3 years, which I think would be quite easy to do for a start-up company. So how does the actual relief for the investor? How does the relief work? So if I've gone out and invested in a company that does qualify for SEIS shares, and I've invested £100,000, when I then do my income tax return in that year, I can claim 50% of that £50,000 against my corporation tax liability. So I've halved it. And if I want to, I can carry that back 1 year to the previous year. If for whatever reason you happen to miss the claim of SEIS for whatever reason, you do actually have 5 years from the 31st of January following the tax year in which you made that investment to go back and make that claim and get that refund. That's very, very generous, that relief there. And from a capital gains tax, you've got two reliefs from an investor's point of view. Supposing you go out and you dispose of an asset that's chargeable to capital gains tax and you've got a chargeable gain. As long as you go and reinvest 50% of the chargeable gain, i.e. the proceeds basically, in SEIS shares, but you've got a limit of obviously the 100k because you can't buy more than 100k's worth of shares, you will get 50% max relief against that chargeable gain. So you can reduce your chargeable gain by £50,000. And another important point is you don't actually have had to sold the asset and then reinvested in SEIS shares. You can invest in SEIS shares and then have a chargeable gain. It doesn't matter what order they come as long as it's in the same tax year. So you can reduce your chargeable gain just by investing 50% of the proceeds into SEIS shares. And if you do hold those shares for 3 years, when you do sell them, there'll be no capital gains tax. It's completely and utterly tax-free. So not only do you get 50% of whatever you invest, whatever it costs you to invest in those shares against your income tax liability, as long as you hold them for 3 years, when you sell them, you're not going to suffer any capital gains tax either. So very, very lucrative relief there. And what HMRC actually do is, because these are small start-up companies, they're a bit scared, they don't really know if they will or won't qualify, they have what's called an advanced assurance facility. So you go to them, explain what your proposal is, what your company does, what you want to do to raise equity, and they will say to you, yes or no, you're going to qualify. And then you can go out and show your investors, look, we will qualify. And then as soon as we issue them shares, you make an application to HMRC, they issue, it's called a SEIS 1, they then come back with an SEIS 2, which goes to the company, and an SEIS 3, which goes to the individual, and they use that to claim the relief on the income tax return. There's only 6 differences between SEIS and EIS, and I'll quickly tell you what they are. Instead of being able to claim up to 50% of the cost of the shares against your income tax liability, it's 30%, but instead of being able to only invest 100k, you can invest 1 million per annum. The company can only raise 5 million per annum under an EIS, and instead of being 25 employees, it's 250 employees, so much larger. The gross assets, as I said, the stock, debtors, cash, fixed assets, have to be less than 15 million before you issue those shares, and 16 million after you've issued those shares. And instead of 3 years to spend the money, you've got 2 years. But I think they're able to do that.